Okay, so let's step back a little bit and kind of take a bird's eye view on things, and by things I mean I guess investing in general. There are a ton, just like any industry, there's a ton of what can be, I suppose, some pretty intimidating terms when it comes to investing, the market in general. I'll tell you that about 99% of what you hear on a daily basis related to the stock market, though, is really essentially just noise. So I want to recalibrate a little bit before we get into the next few slides. I'm going to try a metaphor here. I'm not quite sure it worked as well as I was hoping when I went into the annual meeting, but you be the judge as we get to the end of the next few minutes. Here is how most people view the stock market. Essentially, a casino. And by that I mean most people decide to buy individual stocks, it seems, because they believe they've found some, real important bit of info that nobody else has discovered, or at least not too many other people have figured out. Sometimes that relates to new technology. Sometimes it can relate to something dire happening to a competitor of that company. But in the end, those sorts of investors, and there's a ton of them on Wall Street as well, believe they've kind of foreseen a huge change in the conventional view of a company really before the general public. Now, keep in mind there's no rational basis for presuming any expertise in these discoveries by those investors other than, is just new to that person. But in this view of the world where the stock market is just a casino, you're not really concerned at all with what a rationally derived valuation of an underlying business might be. You're just really sort of caught up in what the price of the stock will do when the less informed masses finally catch on to your particular genius in this discovery. If you invest that way, you're forced to obsess about call it the anticipation of impending changes, whether that's just news or sentiment or whatever. You're obsessing about the anticipated impending changes to a current opinion that has really been adopted by the general public. So I think there's a metaphor for that kind of game, and this is not necessarily my metaphor. I apologize. I don't remember who came up with it, but it's been floating around out there for a little while, and I do think it speaks to at least what I'm trying to get across at this point. Imagine a newspaper competition in which the competitors have to pick out the prettiest faces from 100 photos. The winner of this thing, though, is the person whose choice most closely matches the average, of all the other places' choices. So each competitor has to pick not the face that he thinks is the prettiest, but the one that he thinks everyone else will think is the prettiest. And everybody else is doing the same sort of thing. So not only are you not picking based on your own best judgment, or even the face that you think others would think would be the prettiest, you're sort of out there another degree where you spend a ton of time racking your brain trying to anticipate what the average opinion will expect the average opinion to be, if that makes any sense. The point is, you might win that game, but not consistently, and probably not before going nuts. The problem is there's no real repeatable process to win that sort of metaphorical game. And every time you play, your odds of winning are basically staying the same, which is essentially very low. So here is how I think a professional investor or a portfolio manager, and again I'm biased, but how that person should see the stock market. Let's consider the stock market the world's most interesting game, and calling it a game not because I want to take it lightly, but more in order to sort of cut off all the emotion that can come into play when people are talking and thinking about money, just to kind of make it a purely intellectual exercise. And let's call it the most interesting game in the world, just to underscore that you'd love to win this thing. So this game takes place in this kind of strange world called the stock market, which, in sort of a rational viewpoint, is essentially a place where people who need cash today can get it by selling a stream of future cash flows in today's dollars, but by selling that stream of future cash flows to other investors who are willing to wait for the cash payoffs. And for the sake of the argument, and to really, I guess, complete the trip down the rabbit hole on this metaphor that may or may not be working, let's assume that the referees in this game have been either missing or asleep. A lot of the players have huge egos. The point is, it can get very chaotic in this game. Though, as one of the players in this thing, there's two fundamental laws about this investing thing. Number one, the future is uncertain. And number two, that values and prices are eventually going to converge. It's not even necessarily to know why. Even Ben Graham himself, the father of the value investing philosophy, at some point, I think in the early 50s, where he was testifying in front of a congressional panel, and one of the congressmen or senators asked him point blank, well, how do you know, Mr. Graham, that these prices and values are going to converge? And he essentially made it, I don't know, they just always do. So the point being, just sort of take that as a fundamental underlying law. The prices and values are going to converge. Might not be where you want it to, part of the problem, but it is one of the rules of the game. Along the way, you have other insights about this investing thing, including, you discover that this whole compounding thing, man, that's really indistinguishable from magic. And that probably the default setting you should have as an investor is that on balance, or on average, both prices and values of stocks are going to rise over the long term. So, you've got so many people out there. A lot of them are very smart. We've got a lot of institutions playing this game. I think a fair question to ask is, well, how do I think I can really beat the market? Or how can my portfolio manager believe that he's really going to beat the market or beat everybody else in that game? And, that same question is kind of synonymous with, well, how are we going to earn superior returns? How am I going to justify investing in something other than an index fund, really? Well, maybe one of the ways to answer that is to sort of, as Charlie Munger likes to say, invert. So let's put that question of how can I earn superior returns, how can I beat everybody else, to the side for a minute, and let's focus on how can we be sure we screw up in this game? If we really wanted to screw ourselves, how could we do that? Well, you can probably read the text just as easily as I put it up there, but the bottom line is you can screw up if, number one, you don't really need or want that cash as much as other folks. If a lot of people really want money right now and you don't really care about it as much as they do, odds are you are going to be separated from it on favorable terms. And, if you don't do your homework and other people do, that's probably a pretty good way to lose. One way I would posit, excuse me, one way to ensure that you or your portfolio manager doesn't make that mistake is really to be sure that he or she has some skin in the game too. I think that speaks a lot to spoke funds in general, but kind of a tangent. You could also blow it pretty spectacularly, I bet, by just ignoring history and not even bother to learn from other people. Getting too caught up in, complaining about the lack of referees in this game or the egos of the other players. They're both just sort of givens. Got to roll with it. If you forget those sort of two fundamental laws, if you make the mistake that the future is knowable, even if only by you, or that value and prices are going to really differ forever, it's also a probably a good way to fail. The last one is probably the most important, though, and maybe the most relevant, although I admit at this point a bit strained. If you misjudge the size of the stream of future cash flows, or how long you're going to have to wait, both of which are synonymous with paying too high a price for those future cash flows, then then you are essentially fooling yourself. So here's the corollary of that. To answer the original question of how can we maximize the probability of earning superior returns, these are just really the other sides of the coin, the core opposites of those last bullets. By being selective, by learning from others, by trying hard to tune out the noise, you still need to pay attention to the signal, but again, there's a whole lot of noise and not much signal out there these days especially. You need to be good at estimating cash flows and valuations. Patience is really probably that much more important today. Finding sort of that valuation floor. It speaks a little bit to the margin of safety concept, but more to the point, you want to avoid paying too high a price. Really, you can screw up a couple of these other things, but the unrecoverable error is the one where you pay too high a price for something, at least in the investing world. So again, it can be chaotic out there. There are no guaranteed ways to win all the time. But, nonetheless, it would seem from a rational perspective, the way to win probably starts, with doing the opposite of the things that would guarantee you would fail. So, I think that means really many things. Being tight-fisted to the extreme when it comes to commissions and taxes and fees you may pay. Learning from others, and really that whole list that I may be beaten to death at this point. But the point is, there needs to be a process, and you need to be able to learn from that process. One of my favorite quotes when it comes to investing, or value investing more specifically, was along the lines of, you can invest in the market without a philosophy, but it's kind of like running through a dynamite factory with a lit match. You may survive, but you're still an idiot. And I think that that speaks a lot to to many things, including being an investor these days. This is sort of you can't have you can't talk about value investing publicly without having a slide that shows Warren Buffett, and so here that slide is. I seem to use that joke probably more than I should, but still gets the laughs, at least from my mom. So thanks, Mom. The whole point about value investing, at least that I would summarize today before we move on here, is that it can be a little bit quaint. I think there's something not quite right, both with this picture of Abe and his boombox, and with the idea of investing by really sitting around reading a ton of stuff, annual reports, SEC filings. In this day and age where everything, they guesstimate about 70% of the daily volume on the major exchanges these days is specifically computers. It's algorithms, trading with algorithms. The average holding period for a stock these days, or at least back in 2010, the last time I know anybody studied this, it was 22 seconds. So, to be an investor who really sits around reading anything longer than a paragraph these days, it seems a little bit outdated. But the reality is it works, and it has worked for a while. It doesn't work every year. This year it's been working well for us, and I suspect and hope that it will continue in the future. I don't plan to change anything, but the point is also that if there's a downside to value investing, it's that it does take more work. There are much longer days of actually reading annual reports and industry profiles and all the footnotes in the financial statements. And there's just a real risk of looking like an idiot because you're buying companies that make a lot of people nauseous. This time last year, Clearwire and Dell, to publicly admit that you would deign to own either one of them, you'd basically get idiot stamped right in your forehead. And both have turned out pretty well from a return perspective. To people playing that other game, the casino game, the one where a stock is just a piece of paper that changes hands a lot. Those long-term investors, value investors, like you are here. Even when you're successful, you don't really seem to get any respect. If you're good, it confirms that you're kind of odd. And if and when you buy, you screw up buying a company that nobody likes, and generally you sort of get no mercy. The other, and I guess final piece of this that I would throw out there right now is that being a participant in this game that is the stock market, one of the other implications, to go back to those sort of two fundamental laws, is it implies that you have to buy assets with cash flows, or at least a high probability of realizing a growing stream of them at a certain time. Only assets, or substitute the word companies, only assets or companies that produce cash flows are going to return your money without depending on the whims of other investors. So if you're investing without any regard at all to cash flows and or the underlying business, you might as well be playing the ponies at Preakness, really. Okay. I don't know if that metaphor worked or not, but I'll leave it at that, and maybe continue to work on it myself before the next meeting.